Good morning, this is Ken at Tortoise Capital with a review of the weekend trading reports for April 7th, 2018. Market is in sideways volatile. That means that we're going to be emphasizing the shorter term intraday trades and wait for the market to regain directionality before going all in for swing trades. Shorter term time frames, be open to either direction. Look for the intraday winners, cash them when you have them. That's the general guidance going forward. We are neutral with respect to the annual weekly RSI 14 and the shorter term 10-day index. In the market mosaic, things looking gloomy with price in red sideways near the 200-day moving average. Of 50-day moving average's slope is red bearish at minus 0.76. Bears are in charge in ADX with a strong trend of 25. The risk index is the 30-period moving average of the VIX divided by the 10-period. That score is at 0.908 right now, so we are deeply into risk off. Take that score, look to the last 5,000 trading days to compute the risk Z by finding the average and standard deviation, and the risk Z is the number of standard deviations below the long-term average for that indicator. This is a 90-day histogram of that indicator. You see that we've came down to minus 1.5 Z, and we are right at minus 1.1 Z right now. Starting to hook up. This is the beginnings of potential swing opportunities. So even though we're sideways volatile, there could actually be some that emerge from this, but we will be very judicious to find those winners. In the blended monthly rebalancing, the next reevaluation is on 1 March. These are the current holdings as a function of Friday's closing prices. Theoretical exposure in ETF2 is at 10%. There's indecision around the world. These are the leading candidates in the various blended monthly rebalancing portfolios. The 13 ETF, you see the predominance of cash. Only Latin America holding up relatively well here. Same thing in the ETF 32. In the Dow 30, Nike and Intel, Coke and McDonald's, Chevron offering some opportunities here with respect to the moving average signal, but you just notice the weakness all across the board. I'll be looking for those elements that had significant 1 week moves as a way perhaps to look at some momentum plays. Like DuPont had a nice week after coming off a monthly shellacking. Nike showing some evidence of rebounds, and United Health as well. In the sector spiders, only a handful looking favorable right now. Again, I'll be looking at the 1 week outperformers and the 1 month outperformers as a way perhaps to find some emerging strength at this turning point in the market. ETF Max, these are the ones that have had the greatest returns over 1 week, 1 month out of an ETF database of over 500. Again, looking for the same logic. Market health check. The vertical blue lines are 10, 20, 30, 40, 50, 60 days of look back. Horizontal purple lines are price targets on the way up. These used to be support, are now resistance, and become reasonable profit targets. The top level one here is what I'm treating as the actual swing high at the top of the hump of the dragon. The horizontal red lines are support levels, which when they break become price targets on the way down. You can see the 200-day moving average has come back onto the screen. You can see the slope of the 30-day moving average showing negative now. It's below the dotted zero line, and it's reading right here at minus 0.50. That's an extremely negative reading for 30 days. Anything below minus 0.22 is significantly weak. So that's where we are now. In the MACD histogram, we've had an excursion below the zero line, but the signal line has crossed the moving average, and so there is a potential for some gains in here. So we will be looking at this double bottom approximately around 260 in SPY. That's got to hold. Basically, the 200-period moving average has to hold to have any hope of recovering any of these, what felt like easy, obvious gains here have really been shredded the last 50 trading days. Quite a change in market conditions here. In the ETF regional report, everything except Latin America on a cash signal. The globals at 49 are now stronger than the S&P at 47, so it's shifted to the internationals. Inside the U.S., it's technology at 56, then small caps, then mid caps, and then the large caps. Strongest remains U.S. tech and Latin America. Two weakest are Asia less Japan and the Euro 350. Not much good news anywhere in the S&P spiders with the exception of consumer discretionary. All of them are below their are negative on a 5-week basis. Market health check. The U.S. is generally above average. Asia is a mixed bag. Europe is a mixed bag. Really only Brazil and Latin America showing any kind of strength. You're seeing some of the alternate asset classes beginning to show some interest here. Commodities, oil, and gold. ETF top 30 using that ETF2 lens. I look for the green and whites as emerging strength. Solid greens across the board are long-term winners. So I'll be looking at treasuries, Italy, and the commodities as potential gainers. ETF liquidity just summarizes the average 30-day daily dollar volume for the most liquid ETFs. Shifting to the daily. No signals in channeling and overreaction. The 10-day max pain candidates to me are logical places to search for opportunities on recovery if that 200 period moving average actually holds. Few mechanical signals in the Dow. Only Cisco showing well on the auto framer. That has a combination to do of expanded volatility here to make it difficult to find 2-to-1 reward to risks using range risk. Lots of good frog quality numbers though. You see here in the green the symbols that people were willing to hold over the weekend. In the ETF 30s, again, also very few mechanical signals. Gold testing at 3.4-to-1 on the auto framer. Pinch and stretch with gold and silver, the only super pinch candidates. You can see some of the defensive plays here and the most positive Z stretches, the VIX treasuries. Mexico showing pretty well. Coke and McDonald's showing up again as positives, so I'm going to investigate them closely, and we've been interested in Nike for a while. On the negative side, technology getting a shellacking here. The Qs, the XLK, Cisco, and Microsoft all on that top 10 negative Z stretches below their 30-period moving average. And then the most expanded pinch boxes, these are the ones that have had the most continuous extended 30-day directional trend and how significant that has been on a Z-score relative to their own performance. In the auto framer, nothing really to see on that one. In the regression line fractals, you can see in the top shelf, these are the symbols that are the most ATR below their long-term fair value, and so these are candidates for deep value plays. All the usual suspects. And then on the bottom shelf in the red, these are the ones that are the most ATRs above their own RL270 and may be getting out ahead of themselves or becoming new emerging relative strength leaders. No squeezes today. Quick look at the mosaics. Again, the general downward slanting of the market and failure to make new highs. That rejection at that doji is telling, not promising. Slope of the 30 is now 2 standard deviations or more below its long-term average and negative. You can see that these turning points after these long extended moves become important demarcation points for swing trade shift of trend. So it's good to pay attention to those. We're holding steady here at 2 standard deviations of stretch with respect to the 200. We're right at the 0 line. That's what that dotted red line shows. We're near the 200-day. So that puts this entire move, the entire Trump bump at risk. The more he talks, the worse it is. This is more from the market mosaic. Nothing really to see there. Slopes of the 3 Z-scores of the regression line slopes. Now the long-term 90 has pulled back to the long-term average. The 30 is showing sadness and is 2 sigma below its long-term average. And you can see just the wild oscillations in the 10 That's what is typical of a sideways volatile market. You can see the lack of directionality here, and the reason to have a short-term orientation is you get long moves, but they're in short periods of time. That's the definition of volatility. And that's everything we want to talk about this weekend. Keep your risk measured and your powder dry.